Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss the reasons that may be contributing to the sideways action in the market, with stocks stuck at all-time highs. And Phil, if we look at our first slide here, you can really see it, particularly over the last week. While we're at all-time highs, we're just kind of stuck there.
Yeah, and we've had a really good earnings season. So typically you'd expect with positive earnings, good earnings growth, that the stocks would have increased in price. As well as that, we've got interest rates well below where they were 3-5 months ago. So that's usually supportive of stocks rallying as well. But to your point, we are kind of stuck in a range. We're stuck pretty close to all-time highs, but we're not exactly accelerating, even though we've had some really positive fundamental news on stocks.
And Phil, if we look at our next couple of slides here and catch up on COVID data, is it due to the uncertainty around the COVID variants that we're stuck in this range?
Yeah, I think in reality, there's two sort of tail risks at the moment that are making the markets a little bit nervous. And one of them is COVID, which is the risk that the markets shut back down and we sort of slow the economy down. The other is all of the stimulus and the risk that we overheat the market and end up with a whole of inflation. And if you look at the COVID data, though, it doesn't really seem like the markets are that concerned about COVID. So when we think about what's happening in the US right now, a huge increase in new cases, pretty big increase in hospitalizations, but the deaths so far haven't kept track with what we would normally expect, which is good. And actually, if we look at what happened in the UK, where they had a lot more people vaccinated, they had relatively small quarantining just of the people that were sort of contact traced it. They managed to get COVID under control. And even though they had the spike that they had, they also saw very low COVID deaths. So there's a lot of evidence that says the vaccinations are working. You can look at the fact that a lot of the states with high vaccinations have much lower hospitalizations. You can look at the fact that by age group in America, those 65 plus people who are much more, tend to be much higher vaccination rates, are not the people ending up in hospital at the moment compared to the sort of previous ratios, to show that the vaccinations are doing what the vaccinations need to do, which is to keep us healthy enough to mostly keep us out of hospital and keep us alive.
And Phil, if we look at our last remaining set of slides here, I really feel like this is the bulk of the question. What about inflation, the Fed's transitory perception of it, and of course, jobs?
Yes, of course, we had inflation numbers this morning and they were still pretty strong. So, yeah, well over 5% on the headline inflation number, over 4% on the core number, which tries to, I guess, take out some of those short-term volatility that you get from squeezes on supply and demand from energy, like gas prices and food prices. So both those numbers are still running pretty high. Sort of 13-year highs, really going back 30 years. We haven't had inflation much higher than that. But the Fed thinks that that's transient. And there's a couple of reasons for that. One is some of the inflation is coming from hotels and airlines, which are getting back to normal. Some of it's also coming from cars, from rental cars and from first and second-hand car purchases, which are really expensive right now just because everybody's getting back to work, going on holidays, renting cars, and there's chip shortages that have been caused by people. Back when COVID hit, everyone thought we were going to need chips for PCs, not for cars. And so there's a big backlog on the chips that are making cars, like the supply of cars, shorter. And so what's happening on the production side for cars is affecting inflation. But I guess the bigger risk now is what's happening on the wages side. So if you look at some of the earnings announcements and things that people said, there's a lot of fear for labor shortages and supply chain shortages. And that's pushing up prices. It's pushing up input prices for companies. It's starting to push up some of the wages as well, especially in the leisure and hospitality and retail sectors, which are now starting to grow now that we've all got, well, a lot of us have vaccinations and we're starting to get back to the old normal. And so with all of that happening, there's a risk that we will have inflation on wages as well as goods that might actually persist for longer. The Fed, to your point, is still holding out hope that it's transient, that the inflation comes back down. And one of the things that they're holding that hope out for is there is still a lot of unemployed people out there. By some measures, 7 million people still looking for jobs. And you can see when you look at the growth of GDP, it's outpaced the growth of employment significantly. So if we can get people back to work, if we can get everyone vaccinated, we can get schools open, it looks like we will have extra people coming into the workforce, and that might help to pull back wages and sort of, I guess, level set us before we get to December, and we can sort of move forward with a more normal outlook. But two completely different risk scenarios, as he said. One is for a shutdown because of COVID, and the other is an overheating because of the stimulation, which are both kind of negatives for stocks in a way.
Phil, we're going to keep you economists busy, aren't we, with all this data? Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.